The Shanghai business park market has been very active during the past year, and I'd like to have a quick recap of the 2013 highlights, identify how these recent trends are likely going to impact the market over the next several years, and finally touch upon some opportunities for investors and end users. But first, what is a Shanghai business park? In Shanghai, we have 8 established decentralized areas we define as business park zones. Ownership can be government or private. Land may be zoned industrial, R&D, or commercial. Buildings can be a small 3-story standalone all the way up to a 36-floor traditional office tower. Preferential policies can be very aggressive or little to no preferential policies at all. The definition is broad. The real common denominator is the end user. These 8 locations are where end users prefer to set up or relocate when they consider decentralized headquarter offices, R&D centers, corporate campuses, or just cost savings. The major news for 2013 was that funds, which have been exploring the business park market for years, finally entered and made significant investments, which leads to a more diversified landlord pool. The quality of the new supply in 2013 continued to improve with good quality products. Sandhill Plaza, for example, is essentially a grade A office building in a business park. An American institutional investor invested in this asset. The quality of Shanghai Business Park Phase 3, coming online in 2014, is also grade A quality. 2013 can be characterized as having strong leasing demand for business parks, particularly in Jiangjiang High-Tech Park. In Puxi, as new supply was constrained, absorption was limited. Looking ahead, one of the major market influences will be supply. The idea that office-use business park properties, in contrast to R&D usage, generates the highest value for decentralized landholders has been growing for some time. The result of this is the upcoming construction boom over the next 3 years, with more than 3.8 million square meters of new supply coming to market. As a point of reference, historical absorption has averaged at about 600,000 square meters per year. The obvious result will be the big opportunity for tenants as the new supply comes online. We expect to see early mover advantages and significant commercial incentives for the anchor tenants and Fortune 500 requirements. The automotive, IT, and pharmaceutical industries were very active. As such, they had strong demand for office space, many of them settling in business parks. Despite this new supply, we do not expect average rents to drop, and in fact are forecasting rents to continue to increase. The reasons are a combination of the following: improved quality of construction. The new high-quality projects are going to command higher rents, and that's going to push up the average rent as a whole as they're added to the basket. Improved infrastructure and amenities in the business parks will attract some of the traditionally smaller office tenants with higher budgets. And finally, in a recent survey of American business leaders, for the first time in Shanghai, the #1 business challenge was rising costs, higher than that of HR constraints. Business parks with a 60% savings to CBD offers a real, tangible business solution. From an investor standpoint, as capital values increase, we expect investors to look for lower quality buildings that don't have comparable quality standards to new developments. This offers a chance for upgrades and repositioning, or value add. To date, this hasn't happened much. However, these type of properties are going to become a prime target. In summary, as the Shanghai CBD continues to expand outward and infrastructure and amenities improve, quality business park properties will increasingly be a target for investors and a destination for a broader range of occupiers.